Brad Simmerman, and welcome to Street Check, the best normally two-man podcast in the history of Cabot Wealth Network. This week is a weird one. My normal co-host is out of the office on vacation. I am coming down the hill on the other side of COVID, so I'm a little bit loopy. We are going to take a page out of the Diamondbacks World Series run playbook and embrace the chaos. Um, Instead of our normal rundown, instead of our normal big three and defend the take and then main segment, we're just going to go through some news items from the week, which has been a pretty wild one in the market. And then I'm going to invite my producer Madison on, and we're going to talk about saving for college. My kids are both at an age where they are right about to go to college or whatever their sort of post high school lives look like. And she has one that's just about one, so she's still got ample time to start setting money aside if that is what if that's what's in the cards for her and her family in the future. But we'll find out a little bit more about that later. So let's get into it. The big thing this week, a lot of volatility in the market. We had a real rally in the middle of the week. And then the last 2 days have entirely reversed that. The VIX hit its highest level since 2022. It's up to 29 earlier today amidst all the selling pressures. It's been a kind of a wild week. We've got a ton of earnings numbers to go through. We had the latest Fed announcement, right? They hinted at cuts to come potentially in September. No cuts now. Right now, the market is responding as if the Fed should have cut already. And part of that is in light of a jobs report that came out this morning showing that we had 114,000 jobs versus 175 or so expected. And unemployment ticked up to 4.3%, whereas there was a 4.1% expectation. So the economy is showing a little bit more weakness. There's fears creeping in that the soft landing may not be in the cards and that hard landing is back in play, which would be sort of recessionary. I think is the general consensus. If that hard landing hits, is that it will translate into a recession. We've already seen some indications that there's weakness in the labor market, and now it's just hitting headline numbers in a way that people are paying a lot more attention to. We have seen the 2-year and the 10-year. Those two yields have been inverted for over 500 days now. They're starting to rapidly disinvert, which tends to be the marker for the beginning of the recessionary period, right? I know there's been a lot of pushback against the idea that the yield curve inversion signals the recession, and then the bullish take on it is, well, they've been saying it's going to signal a recession for over a year now. It's been inverted for so long. Well, now we're seeing that rapid disinversion, which is typically bad news for the market. And I think that's part of why we're seeing a lot of the volatility. As we are recording this right now, the S&P, NASDAQ, all down about 2%. Now, NASDAQ down closer to 2.3%. Russell down 3.5%, and Dow's down about 1.9%. So we're seeing broad selling. Small caps had sort of set up earlier this week as the natural rotation target for a lot of the excess investment in big cap tech, and that was really that was really coming into play. But with the risk off mode that we've been in for the last couple of days, even the small caps are suffering more. It is also the heart of earnings season. We've seen reporting from some of the biggest tech names. So let's take a look at the earnings reports that we've had this week. We're just going to look at, I don't know, about 10 of the larger names that we've seen report. Starting Monday, we had McDonald's. They are up about 7% since they reported on Monday. Their comp sales were down 1% year over year. Revenues were flat, actually up about 1%, and their earnings were down by about 11% year over year. Their management cited some weakness in the consumer. Consumers have become a little bit resistant to the price hikes. They've become a little bit more discerning. And that's been hitting some of these retailers, some of these names like, Starbucks. Recently saw a commentary that Johnny Walker was seeing sales declines as well because of a less resilient consumer. Then Tuesday, we had our first big tech name, Microsoft. They actually had a double beat on revenue and earnings, but they're down about 3% since reporting. They were down as much as 7% the day after in extended hours. Revenues were up 15% year over year, but the sell-off came on news that the Azure unit was slightly weak. So this is consistent with a lot of what we are seeing this earnings season, which is weaker forward guidance, where it's tougher for companies to justify their sky high valuations when you're not guiding for really impressive growth going forward. For Microsoft, of note, Azure is also where their AI unit resides. That's their cloud environment, and they don't do a great job of like partitioning out their earnings based on what's AI and what's not. Same day, that was Tuesday, AMD came out and reported a double beat as well. They are, as of right now, uh, they're about they're down about 1%. They were up 9% overnight after reporting on a 15% revenue beat for their data centers. But again, like with Microsoft, it's just softer guidance looking forward. We are hitting that sort of rubber meeting the road environment. We've talked about it. I'm sure I've overused that term multiple times on this podcast. Then on Wednesday, we had Meta Platforms. Um, they're up slightly after they had a double beat. Revenues were up 22%, earnings were up 73%. And the big thing for Meta was that they guided for significantly higher capital expenditures. They are continuing the AI build out, as are most of these big tech companies. Um, but the downside is, while they're willing to keep spending more, we're not yet at a point where their customers are embracing spending more. So that money is flowing through to some of the big chip manufacturers, companies like your NVIDIA, your SMCI, right? They can continue to sell to the individual big tech companies, but the end users have been sort of reticent to jump on this AI bandwagon. And there are real questions about how much flow through there will be from the end users to the bottom line, because unless they're willing to spend and spend pretty impressively, there are some legitimate questions about how sustainable the current trajectory is. Uh, we had ARM reporting on Wednesday, so same day, down 22% since reporting. Their revenues were higher by 39%, but again, soft guidance. I don't have a ton to add there. Semis have been really hammered this week. Then Thursday, after the close, we had Apple. They're up about 2% after reporting. So perfectly sort of reasonable earnings response. Intel, they're down about 30% in the last week. They were down as much as 27% today alone. I think right now they're down about 25% as we record this. They had really a terrible quarter. They announced a new round of layoffs. They suspended their dividend. And one of the difficulties with Intel is they're currently trading at a price that they last traded at a decade ago, and at a price that they last traded at back in like 1996. So the equity price, the share price is the same as it was almost 30 years ago. The dividend is really the only source of returns long-term investors have had for Intel. So if they're cutting that dividend, it's a really bad look. There's not a lot of juice to squeeze in that stock. So it's not a huge surprise that they are down so much after that decision, given how lackluster their overall performance has been for the last 3 decades almost. Uh, I mean, the idea of something trading at sort of pre-dot-com levels is it's a surprise. I cannot think of another name that is trading at levels that it was at before the dot-com bubble even burst. I mean, You had names like Cisco, right, where they ran up going into the bubble, but I think even their post, I think even where they're trading now is above where they were trading before the dot-com run up. Um, Amazon, they are down about 10% today after they reported last night. And again, it's the same theme. It's consumers weaker than they have been in the last 18 months or so. Guidance going forward is softer. So there's still a lot of money sloshing around, especially when it comes to tech build out. But where it's going to come from in the future is becoming a big question. We also had Coinbase report last night. They're down about 4%. They doubled their revenue over the last year, but their profits fell 97%. A big part of that is due to crypto accounting, where you can either start using a mark-to-market accounting. This is something that MicroStrategy has to deal with every quarter that when they report. You either start using a mark-to-market accounting or you have to effectively treat it as realized losses on a quarterly basis. Um, it's supposed to, I mean, it's supposed to improve transparency, but ultimately it's kind of just a difference of opinion when it comes to the accounting. Um, Coinbase, most of their losses coming on their own crypto reserves. I think Chris and I have been abundantly clear about our stance on crypto, where it's a tradable asset certainly, but it's not a long-term investable asset. So anytime you're getting involved with a company whose core value proposition is that they hold a bunch of crypto. And obviously with Coinbase, that's not fully the case, more so with MicroStrategy. Coinbase is more the toll booth operator on the crypto highway. But when you get into a company that derives a majority or a large share of their revenue from crypto assets they have on hand, you're sort of playing with fire naturally. All in all, it's been a tough week. It's been a volatile week. Tesla has swung back and forth in 6% increments twice this week. Up 6%, down 6%. Haven't looked at their performance today, but all these big names that have been really driving the market higher are running into difficulty right now. I think consumers are finally waking up to the proposition that the the soft landing may not be as easy to reach as we'd hoped, and that there may be more hiccups on the road. Is it enough to invalidate the bull thesis? No, not yet. We're talking about one bad week in the context of a year where the major indices are all still up double digits. Uh, could just be another correction. I think right now we're a little bit lower than where we were in the April sell-off. Does that mean that we keep going lower? We bounce back? I don't know. It's really tough to say right now. Uh, Obviously Nvidia's earnings later in August are going to be a big market moving event. But for the time being, I think we're just going to have to take this as it comes, because we are getting closer to a bad news is bad news scenario. The Fed has essentially outlined that September cuts are what they're looking at. Um, there's no amount of bad news that can accelerate that at this point, right? The July window is closed. There are some in the street that are saying that the Fed should have cut in July. I had floated that as sort of a dark horse possibility, but obviously that didn't land. But now that that's all in the rearview mirror, any bad news that comes out isn't going to accelerate the Fed action and rate cuts. So to the extent that the rate cuts are a bull catalyst, there's nothing to really juice that any longer. It's really going to be up to economic fundamentals for the next few months and individual names earnings reports. Some companies are still holding up really well. Microsoft is still in solid shape, even though the semis are selling off. Apple's still in solid shape. Excuse me, solid shape. So some of these like fundamentally strong companies are seeing the selling in some of the overbought areas of the market, and they're weathering the storm pretty well. So pay attention to the companies that are showing some strong relative performance now, because they're a safer place to be and potentially in a good spot for whenever we resume the bull trend upward. Um, I think that's about all I've got for earnings. So what we're going to do is I'm going to welcome on producer Madison, my best friend, and we're going to talk a little bit about saving for college. Madison, welcome.
I'm so happy that that is recorded in public knowledge that we are best friends.
Now you're my best friend. Yeah, best friend Mads.
Yes, yes. Then I can't pretend to be Chris today. I was going to try to be Chris, but he's not your best friend. I am. So I'm just going to
Yeah,
be me today.
good. I asked you to be on here as you. All right.
Good. My
So
first impression is bad.
this is more like personal finance and like educational than stock related. Um,
Good.
so I don't know that it's a huge deviation from what we normally do on the podcast. Although I will say it is way better being able to like look at your face on the screen and talk versus having to look at my own face and talk.
I
Um,
You're doing a good job though. You did
thank you.
it. You-
So let's talk about kids and college and stuff. I can volunteer what our thinking had been and where we're at now, or we can start with you and you can tell me where your thinking is at and where you're at now.
I mean, mine's real quick. With her being not even a year old yet, we're still working through the baby basics of sleep training, and every day is so different. I feel like we haven't even gotten a second to really think about or really do much research into saving for her college yet or for her future, which I don't know if that's bad. We've done light research on it. But we definitely need to start soon. Things
So
are
we
expensive.
yes. Oh man, I remember when all right, there are three times when you feel like you're getting a raise. Um, when your kids get done with diapers, because that's
Mm,
like hundreds of dollars a month or $100 a month or whatever that you get. If
yep,
you feed your kids formula at all, when you stop buying formula, and when
yep.
they get out of daycare, when my kids were in daycare, we were spending as much as like a new car a year to get both of them in daycare.
Yeah, and that's
It's
not
so
gotten any better.
no, it's terrible. It is so much money. I could have
Yeah,
had like a Lexus a year for what I was spending to put like a 2 and a 4-year-old in day or a 1 and a 4-year-old in daycare.
and they'll never
Um,
know. They'll
oh, they'll
never
know. I took.
appreciate it.
They won't appreciate it, but they'll know. I'll be on my deathbed, like I could have had a Lexus. No.
It'll be their last thing they hear from their dad. I
God, I
robbed
hope
him of
not.
his Lexus.
Oh man, they hear like I don't. The last thing they hear from me is gonna be like, "Hey, watch this." I'll do something stupid. All right, so here I'm gonna
Very
I'm gonna
sad.
run down what my wife and my thinking had been about college. One
Okay.
is we were both of the generation where it's like you go to college, you get a degree, that's your sort of path to middle, upper middle class, upper class, right? Like that's the American dream. That's your ticket. Just go to college and get through, and you punched your ticket.
Mhm.
Um, she is more like artsy. I don't know, more, I don't want to say counterculture. I'm an odd duck. So we both had the conversation like, all right, well, our kids may not want to go to college. They may want to start a company. They may want to uh, go join the military, and then they might want to go to trade school. Like they may want to work with their
Yeah.
hands. So for us, it was less about saving for college and more just for having money on the sidelines for them, something that's available for them to get a head start. So we were not super focused on using college savings plans, specifically like a 529 plan, because that stuff is
Mhm.
pretty much just earmarked for college. And
Mhm.
there's like some escape hatches that you can use where you can give it to different people, or you can withdraw it and then pay taxes and penalties. And then there's some workarounds and stuff, but it was all pretty complicated. So for our kids, most of what we did is start saving money in their name that is slightly tax advantaged, but isn't really a college commitment. So like
Yeah.
if we have, let's say $30,000 or 50,000, like whatever dollar amount set aside, there is a little bit of a tax advantage. These are called UGMA or UTMA accounts. They're uniform gift to minor or uniform transfer to minor accounts. They're basically owned by the kids with somebody else that's representative of them on the account. So in that case, in my kid's case, that's me. The problem with the UGMA account or a UTMA account is that they are gifts. Any money that's in there is owned by the kid. So once they reach the age of majority, and in most places that's 21, I think there are some states where they have a different age of majority, but in most cases it's 21. The money is the kids. So if you end up raising a kid
Gosh.
that you wouldn't trust with a big stack of cash at 21, you're kind of out of luck because you have to sign it over. The
Yeah.
ta the tax advantage to it, there's something called a kiddie tax exemption, where the first, I believe, $1,900 of earnings, um, of taxable earnings are tax free. That that number varies year to year, like a lot of other things in the tax code, and I have not looked it up, and I have COVID brain. So if you're looking at the UGMA, UTMA accounts, double check what the kiddie tax exemption is. Where that's beneficial is if you buy stuff like mutual funds or like ETFs, you can put money in there and you can collect dividends and income, and then those fall under the kiddie tax exemption. So you don't necessarily have to pay taxes. So if you've got like $5,000 in ETFs and you get, let's say, $400 worth of dividends, those dividends are tax free in the kids' account because they fall under the kids' earning bracket. Um,
Cool.
the benefit of the UGMA accounts is they go to whatever the kid wants them to go to. So it can be a college saving. Um, oh, sorry, I'm going to derail the conversation for a second. One other thing to consider, scholarships, right? I'm a smart
Hmm.
guy. My kids are smart kids. If they get full
Hmm.
ride scholarships and all their money's in 529s, I've got to pay a tax penalty because they got their education paid for with a scholarship. That sounds like a bad bet to me.
Oh,
So the benefit of the UGMA is like, all right, well, this money is yours. If you go and join the army and get like the GI Bill, or if you get a full ride scholarship, this is just money that you have that's available to you to use for whatever you want. By that same token, let's say you really like macrame, or you really like knitting, and you want to open a knitting store. Well, I
yeah.
don't really need you to get an engineering degree to open a knitting store. You could go to community college for 2 years and get an associate's degree in business, and then the money that might have been in the 529 that's now in the UGMA account is like seed money for you to go out and start. It pays for the first year of operations for your knitting store.
Yeah,
So the versatility there is advantageous.
for sure.
Um, where where do you land on the must go to college is the path sort of spectrum?
I I don't. I've seen it work out really well for people. Like my husband's a software engineer, and so it helped him a lot
La di da.
job searching. Like, yeah. But then my job before this was running a nonprofit, and I I did a very small little, wasn't even a technical business degree at a community college to be able to run it because it was so much about um, just networking and just learning from mentors and things like that. I
Mhm.
kind of had just built my own little path to make that nonprofit, and I got truly nothing out of even the 2 years of going to my community college. So, like, with seeing how it worked out for him and then how I really didn't need it, I'm kind of just like, our our kids can, I don't know. I just want them to do what they're passionate about because I think my brother is 10 years younger than me, and he felt the push to go to college. Like, he had to go to college, and he had to work, and he ended up hating college, and he's now starting in trade school and working with a lighting company, which was just so random, but he loves it, and college did nothing for him. So it's like it's just it's a hard thing to say that college is the best move for everybody, because I mean, I didn't experience that,
So
but then my husband did, so
when you were growing up, was that the message that you got from your parents? Was the message that you got from your parents similar to what I got from mine, which was got to go to college if you want to
mhm,
make it, you got to go to
yeah,
yeah.
because that's
I don't
how
know.
things were for them.
Yeah, and I think that's it was something that was really reliable, and it's a lot like we've seen it ourselves a little bit lately, especially your husband, um, where when we were or at least when I, who is much older than you, were going to college, it was like learn to code, right? And you'll never have
Mhm,
difficulty if you learn to code. And what we're seeing now is that a lot of the automation tools are making entry level coding jobs difficult. Um, and that automatic, that guarantee of learn to code is not really a guarantee anymore. That guarantee is
mhm,
now learn a trade, which your
yeah,
brother is doing because you cannot automate a tool that will go into an existing wall and rerun conduit or rerun
yep,
lighting. Like honestly,
that
if I had to figure out a path, I'd be in class right next to him right now.
yeah, and we've talked about that because I think people being good at trades is also dwindling a bit. So, like, him becoming he started working with new construction too. He's doing a couple different things. He's doing new construction plumbing too right now. And like the amount of plumbers when he's 21, 22 now. Like the amount of plumbers even in 5 years when you're wanting to start your own plumbing company and do your own thing, like I don't imagine you're gonna have a ton of competition.
No,
It
a
just
lot of
seems like
these Yeah, a lot of these existing trade guys that are in their 50s, 60s, and they're sort of getting to the tail end of their career, and there's not a ton of guys coming up behind him. I mean, I think
mhm,
he's probably in the sweet spot where, like, 5 years from now, it's going to be that's the group that's going to be affected by the same way that the Learn to Code group was affected, where there's this rush of interest. But I think he's in a good spot.
yeah,
Um, all right. So it sounds like you and I are sort of in similar positions as far as
I
like,
think
yeah,
so.
college is great if it's what you want to do and sort of what your calling demands from you, but it's not for everybody.
Yeah,
So I let's talk let's talk a little bit about what are called 529 plans. Um,
mhm,
529 plans, and this is more for listeners because I don't have a 529 plan for my kids. And it sounds like that's probably not a high priority for you, for your kid, but we'll talk about it anyway because it's like the most popular kind of savings plan. They're sponsored by states, but just because your state offers one doesn't mean that you have to invest in your state's 529 plan. So, like, if you're in Tennessee, you can put your money in like the California 529 plan. Some states have advantages where if you invest in your own state's 529 plan, there's tax deductibility that's not available to like out of state investors. There's one big benefit to the 529s that you don't have with the like the UGMA and the UTMA accounts. And that's if you've got other people that are helping you save, or if you already have a high net worth, you can front load 529 plans. So like a UGMA account, you can gift as much money as you want to a kid, right? If I wanted to gift, if a grandparent wanted to gift like $20,000 to a kid, they could. But
give me those grandparents.
but you start running into state tax implications where you have to write that off. There are some workarounds with the 529 plans where you can front load an investment where essentially what happens is, let's say you've got a grandson and you want to contribute $100,000. Well, you can make that contribution and treat that gift as if it happened over a period of like 5 years. So like you and a spouse could each contribute technically $10,000 a year for 5 years, and that gets you to 100,000. But what you do is you just give 100,000 right up front to the grandkid. So there are tax benefits to that because then you don't have to exclude that from your annual or your lifetime gift exemption. So there are some advantages with really large contributors. One of the other benefits for the 529 plans is they all have state administrators. So it's not like it's closer to your 401k where you can like go in and say, all right, well, I want to be in growth stocks and like these dividend stocks where I want to pick from a limited pool of investments. Um, with the UGMA accounts or with the custodial accounts, as they're called most often, you have to sort of self-direct them and you make your own investments. So it's like, all right, I'm going to buy the S&P, I'm going to buy gold, I'm gonna, like what you have to pick your own investments. So they are a little easier to run if you're unfamiliar with them. They are also transferable, and there are advantages when it comes to student aid. And before we had gotten on the call, I think I mentioned to you that the effective cost of attending college has actually gone down the last couple of years. The average
Mhm.
cost of attendance has dipped a little bit since like 2020. But the main reason for that is that colleges are kicking in more in the form of grants. So if you're in like the bottom four quintiles of income for the college admission. So if you're from zero to like 110,000 in household income, your cost of attendance is going down because you're getting more grants and more aid from the colleges. If you're in the 110 plus category, which is the breakdown from, I'll get the actual, um, where is this? National Center for Education Statistics, right? If you're in that last quintile, the 110 plus, your average cost of attendance net of aids in 22 or 23 was 24,000. If you are in the 0 to 30,000 quintile, the average net price is $9,700 a year for a 4-year degree. It's 11,000 if you're between 30 and 48,000. It goes to 14,700 if you're in 48 to 75,000. And then when you hit the 75 to 110,000 in household income, you're spending $20,000 a year for college. And then 110 or more, you're at 24,000 plus. So if you're a high earner, college is expensive and it's probably going to stay that way. If you're a lower earner or middle income earner, it's actually getting a little bit cheaper. So that is, that's one benefit. Um, the transferability component of 529s. So that means that you can give the money to somebody else that's in your family, so a relative. So let's say you have a kid and your kid gets a full ride scholarship, and then you're using your 529 to pay for other expenses like room and board or supplies. There's a list of expenses that are approved to use 529 money on. Otherwise, if you don't want to spend it on that, you have to pay taxes on earnings, and there's a 10% withdrawal penalty. So you can get the money
Right.
back, you just have to pay for it. But as an alternative, let's say your kid gets a full ride and you've got this leftover 529 account. If if your kid has a cousin or ends up, let's say he has a cousin a couple years from now, you could give that 529 account and spend that money on the cousin. You can also repay student loans. That's a relatively new development. Up to $10,000 of student loans are eligible for
Oh, that's
repayment.
cool.
Yeah, it's not like fundamentally, it's not a bad program. It's just very, very education focused.
Mhm.
So if education isn't necessarily the ultimate end game, or even if it's more hybrid like what you went through, which was life experience and associate's degree, or what your brother's going through, which is education in the form of trade school and then apprenticeship, apprenticeship, right, where getting he's getting paid for his education, right? Like
Yeah.
that you don't benefit nearly as much from like a 529 as somebody whose goal is definitely 4-year college, especially private college, which is still astronomically expensive. We were
Yeah.
joking about MIT for my oldest, who like he's in like the 99th percentile on like standardized tests for everything and like his pre-ACT and stuff. So it's like, all
Dang,
right, it's not impossible that he could go to like an Ivy League school. It's like 80 grand a year to go to
that's
MIT.
crazy.
All right,
That's
well,
wild.
it's like here's the deal, son. You can have 1 year of MIT or 4 years of state school. Your
Yeah,
choice.
yeah, that's wild.
Yeah, it's I don't know. I state schools I think continue to represent a solid value if you're getting like a tick the box kind of degree, especially if you're getting grant money. But you
Yeah.
really got to be committed for some of those really expensive private schools or the Ivy League or Ivy League adjacent schools, and your job really needs to be something that demands a degree. Like it would just
Hmm.
be a tremendous waste of money to like go to MIT and then decide that you want to be a tradesperson where
Yep.
you need, specialization and certification, and you need a different kind of education, but or
Do
even a
your
teacher.
do your kids have the early college option at their high school?
Yeah, Arizona does this thing that they call concurrent enrollment, where what happens is if you're in like an honors class in high school, they count it as a college class at a community college. So
Okay.
like, let's say you're in like advanced physics in high school. Well, that counts as like physics 101 or physics 202. So
Cool.
you can build up a fair amount of college credits. Where
Okay.
it's a problem is when you build up so much college credit that you can't sign up for your next classes because you need like senior level math and you're an incoming freshman. Because
Oh.
that's what I ran into.
Oh. That's fun. I'm wondering why. So I had them in Florida. I did my community college thing in Florida, but I did early college and high school. So junior and senior year of high school, I was actually going to the community college and like taking full college. So I had my AA when I graduated high school, and then just jumped right into my little like community college bachelor degree, whatever. Um, but I thought that was a really cool move, like to be able to even have that option to go for free, and be considered part of high school.
Oh yeah. Yeah, I think with when I was doing it, I think it was like $50 a credit hour. So you could get like a full semester of college for, I don't know, $900 is what it would have been the equivalent to if you were like taking all the right honors classes. There's
Yeah,
probably a sweet spot where you take like one or two, where you get like English 101 and 201, and you get like physics 101 and 102 or 101 and 201. But if you go beyond that, it's diminishing returns.
that's
But
funny. Seems like they would set it up a little differently. That you weren't put in a hard spot like that.
well, would have been nice. I forgot a lot of Spanish because of it.
I bet. Well, you know your colors, right?
Azul, yeah, no, I
That's
remember
all
that.
you need to
Blue.
know. You know how to
Rojo.
get to the bathroom.
See.
Yeah. Look, you're fluent. I didn't know you were fluent in Spanish, Brad.
I used to be.
Learn something
Not so
new.
much. I should have minored it. Should have got my minor in Spanish, but I couldn't get the classes. All
Imagine
right.
that.
So we did have a question from a Street Check listener. They wondered if you would open a 529 if Morgan Wallen told you to.
Okay. First of all, I actually am not the biggest Morgan Wallen fan. I mean, I don't not like him, but I don't really listen to his stuff. I am a big fan of him and Post Malone. They just did a song and released it, I think, last month, and that was pretty good. So I guess if Post Malone told me to, I would. Morgan Wallen, he makes dumb decisions.
Post Malone is the only guy with face tattoos whose advice I would probably accept.
Yeah. Oh, yep. I agree with that.
Happen to like Post Malone myself. That came from Tyler, in case you couldn't
Yeah,
guess.
I'm sure. No, I'm sure. He didn't even know who Morgan Wallen was when I told him that song came out, and he said, "Who are they?" He thought they were two separate people. Was that Morgan Wallen or was it Post Malone? He did that with somebody famous. That
Some
with
guys
one
just
person.
some guys just get older and they don't keep up with the times. Not
I
me.
know.
Never
All
gonna
these
be
old,
me.
we're surrounded by old people.
All right. Let's talk like a little bit of practical stuff and wrap this up. So like with college contribution stuff, college is going to be expensive.
Hmm.
Maybe you can do all online and it is super free 10 years from now. We thought that might have been the case by the time my kids got to college, and it has not been. Like you can get
Yeah.
good educational resources online, but if you want to do the college experience and live on campus and stuff, you got to pay the piper. Um, you can do big lump sum contributions. That's something that happens, right? Like if you have extra money on hand, you can throw a few $1,000s or a few $100s once a year, and it'll build up over time.
Mhm.
Buy things like mutual funds or ETFs. ETFs are easier and cheaper. If you're in a 529, you can only really invest in what the 529 offers. The one thing where I think you will probably get reminded periodically to have some sort of college savings account is like when birthdays and Christmas come around, when
Yeah.
people are like, "Oh, I'm gonna write your kiddo a check for $40 to go in the college fund, or I'm gonna buy this savings bond." Um, you can open like you can open like brokerage accounts with banks, right? Like if you have a Bank of America account that is for the minor child that you're on. That's a custodial account. You can do that and then like move money to Merrill, right? So there are some practical considerations where it's like, all right, well, I've got a check in hand. I don't want to have to mail it in. Um,
Yeah.
it's a really if you look at the cost of college and you're like, okay, well, hopefully my husband and I are making $150,000 a year by the time the kids are in college, then what you're looking at is college is going to be 100 grand over 4 years. So
Mhm.
now you're stuck with, oh, I got to save up $100,000 in the next 17 years, or my kid's going to have student loans. So it can be uh, really defeating to feel
Yeah,
like you've got to
but
come up with $100,000 or 120 or like whatever the actual cost is going to be when you're just getting over diapers or you're just about to start paying daycare.
but
Anything.
I
Go ahead.
our our kid started walking last month, so, like, as soon as she turned 9 months. So at that point, that's when we looked at each other and decided, "Oh, she's gonna be a genius. If she goes to college, she's getting scholarships."
Well, I don't maybe sign her up for like a DoorDash app or something. She could start doing deliveries and start earning for that college.
I'm saying.
Uh, you can do you can do little things like setting aside a certain amount of money every month that can help make it cut it down into like little bite-sized chunks. But if
Yeah.
you look at most of the college savings calculators, they project out a future where college is even more expensive for your kiddos because they don't assume that the amount of grants and contributions from the schools is going to rise. So they might
Mhm.
project out that it's going to be like closer to 200 grand in 20 years. Um, so if you use those calculators, they're going to tell you like you got to save 200 bucks a month or 500 bucks a month already, which for most young parents is pretty impossible. Um,
Um, she better start learning how to knit.
like there's no like magic formula for it. Set aside extra money that comes in for the kiddo. Save when you can. Take advantage of some of the favorable tax treatment for the accounts if you're in a position to, but you got to sort of just weigh whether it makes sense to even use like a 529.
Yeah.
Student loans are really rough for people, so doing everything that you can to reduce the likelihood that your kiddo has student loans is great.
Uh,
But at the same time, they have an entire lifetime to repay student loans. So if you find yourself 10 years from now saying, okay, well, am I going to save in my 401k or am I going to save for college? Well, save in your 401k because you can't earn money once you hit retirement. They can out earn their their student loans, right? They
They'll
can,
survive.
yeah, they can start making more money, or they can do something pretty straightforward like spend a couple of years in community college first and cut the cost of college in half. Go
Yeah.
join the military if that's something they're interested in doing, and use the GI Bill. We have no idea what student loan forgiveness is going to look like, but student loan forgiveness is a program that exists if they are already aligned with nonprofits, like if they have a genetic predisposition for it that they inherited from you, then
Yeah.
there may be some student loan forgiveness eligibility from working with nonprofits. It varies, but a lot of public works and public service jobs have that kind of forgiveness. Like the I feel like the big thing is you just do whatever you can, try and stay on top of it, and
Uh,
don't.
we've Um, we've got a friend who does, it's an app, like, I think they're kind of, I don't know how long they're around. It's called UNest, and it's like a like monthly contribution. It's like having a subscription, but you just put minimally like $25 a month towards your kid's account. And you can receive gifts from people towards their account, and it's just a simple little app kind of
How
deal.
how is this the account owned? Like when you sign up, who owns the account?
I don't know. I haven't looked into it. She was telling me about it the other day because we have a first birthday coming up, and I was thinking about that. Like, we are the don't want the house cluttered with toys kind of
Yeah.
family. Um, so we've been lightly like asking around about this exact thing. And this
Because
is just what a friend of ours said that she does, but I don't know details about it yet. I gotta look into that stuff.
because if it's owned by like you as the parent, then any interest that you make on it, I'm assuming that it's just like a shell that just puts money into a bank account
I think
that
so.
earns probably a little bit of interest. Right now, that's not terrible. Interest rates, depending on the bank, are pretty good. 5%, 4.5%. That's solid for interest for what we've seen for the last, 20 years or so.
Yeah.
Um, 15 years, I guess. But anyway, so like 4 or 5%, not terrible. If rates start coming down, that gets a little bit less attractive, but there's no tax benefit if it is owned by you as the parent. It's going to very much depend on how that is structured exactly. There is a possibility that it could be like a funding pool for you. So you have like UNest, and then what happens is people give UNest money for the birthday, and then you take the money from UNest and you move it into like a custodial account where you then invest in stuff for like longer term, where you could put it in like an S&P 500 fund or like a bond fund or like whatever kind of investment you would want where you could get some longer term returns. So
That's probably what I think this is like a good little small temporary step because it does
yeah,
seem like the first 1,300 of earnings is completely tax free. The next 1,300 is taxed at the child's tax rate.
okay. So
Anything beyond 26 is taxed at the parent's tax rate.
all right, so you actually retroactively did some research for me. That's the standard kiddie tax exemption. So that means it's owned by the child. Um,
Okay.
so your kid is 1,300 is tax free, as it says. Next 1,300 taxed at the child's rate. That is presumably at the lowest bracket unless the kid also has a job. So like 10 years from or no, 15 years from now, if they're working at like 7-Eleven or whatever, then that's going to add to their earnings and you'll have to deal with the taxes then. Did the UNest tell you what it pays? Or did it give you like
Um,
investment options or anything like that?
and investment accounts are held to they're held with. Investments in your account are protected up to 500. No. I mean it may, but I'm not reading fast enough. I'm going trying to go through their uh
It had
little little
500,000 SIPC.
which is better, UGMA or UTMA? And that
It
goes through
depends.
the difference of those.
It depends on the state. They're basically the same.
Okay. Yeah, I don't.
Did
See, I don't see it.
when you were saying your account is protected for up to 500 and then sort of trailed off, what was it there?
Oh, that was answering where is my money held.
What did it say?
Um, Investment accounts are held with a tax clearing corporation, third party SEC registered broker dealer, and member of
Okay.
FINRA.
Okay, so it's a custodial brokerage account. That means it should have some investment options for you. Um, that actually sounds like a pretty good solution. I have not used it. Cabot doesn't endorse products or individual brokers. We don't have any kind of referral relationship. But if I were in your shoes, that would definitely be something that would be worth looking into, especially if it's got an easy contribution option where friends and
Mhm.
family can just send birthday money over there. Because that's like the biggest hurdle where if you're working with a traditional brokerage, like okay, it's like, okay, grandma, go into your nearest Bank of America or go into your nearest
Yeah,
Merrill Lynch office that handles checks and deposit a check
yeah,
there and make sure you write it out to the right person. Like, no, I'm just
yep.
going to put in a check. I'm going to write my grandchild's name on it and I'm going to mail it to you. And then you have
Like
to
the
like
good old
endorse it.
days. Yeah.
Exactly. So that actually sounds like a really good fix for some of the practical hurdles. Um, yeah, that's a good place to start. Uh, it's not as tax advantaged as the 529, which grows tax free if it is used for qualified higher education expenses and even K through 12 expenses now for tuition. There's some limitations on that. But if your kid's going to private school, 529 is a little bit more attractive because of recent changes to the tax code. But for most people that aren't on the college is the only way path, I, I like that option. I would encourage you to look more into it.
Mm.
Let's wrap this up unless you got anything else.
No, that's it. I think I could replace Chris on a weekly basis, though. We'll let the listeners vote.
Yeah, go
I'm
ahead
just
and
kidding.
yeah, like, subscribe, and then vote in the comments below this video whether you want Madison to replace Chris as my co-host and whether or not I should be hosting with COVID every week. I definitely feel like it is a little bit more loopy, but I don't know if it's going to come across that way.
I don't think so. It was
Yeah.
good. Yeah,
Well, thank
you
you for
seem
joining me,
healed.
Mads.
Thanks for
Appreciate
having
it.
me. It was fun.
All
I'll see
right, that'll do it for
everybody
this
next
week.
week. Well, I won't. You guys will see everybody.
Bye.